revenue growth, yet share price says otherwise. Most investors are celebrating 22% revenue growth like a victory lap. They see the $104 billion market cap and think they're safe. They're wrong. While you were looking at the top line, a $404 million nightmare was burying itself in the balance sheet. The forensic red flag. Let's look at the Day Sales Outstanding, or DSO. When accounts receivable grows over 146%, while revenue only grows 22%, it means CrowdStrike is booking sales but hasn't collected the cash. In the locker room, we call this buying your friends. Are they begging customers to stay after the July outage?
The July 19th outage wasn't just a technical glitch. It was a leverage killer. Before July, CrowdStrike had what we call the arrogance premium. They could charge whatever they wanted because they were the best. Now, they're offering massive credits and flexible terms just to keep their net dollar retention, that's NDR, above 120%. They're protecting the story, but the margins are paying the price. If this accounts receivable bubble pops, we aren't looking at a correction. We're looking at a valuation reset. But before you hit that sell button, we need to look under the hood at the hidden catalyst that could save the stock, the most powerful economic moat in cybersecurity. In equity research, we don't care about how cool a product is. We care about how painful it is to quit. We've rated CrowdStrike's economic moat as wide. This isn't just software. It's an ecosystem designed to be a cybersecurity operating system.
The competitive war room. SentinelOne and Palo Alto Networks are smelling blood. But here is why the CrowdStrike moat is still terrifyingly strong. The Falcon platform isn't just software, it's a data gravity well. Once you have 8 or 9 modules installed, ripping them out is like trying to change your nervous system while running a marathon.
The Falcon Flex tech. Every new endpoint is a sensor. When a threat hits a single laptop in Singapore, the entire global network becomes immune in seconds. This hive mind architecture is why, despite the outage, churn remained remarkably low. You don't leave the best protection just because it had a bad day.
The Falcon Flex trap. As CrowdStrike has successfully moved 49% of its customers onto 6 or more modules, 24% of them are using 8 or more. This gives CrowdStrike dominant pricing power. Even when things go wrong, like a global outage, they can keep their 80% non-GAAP subscription gross margins because the alternative, leaving, is even more expensive. They are a price maker. Despite pressure from Microsoft and Palo Alto Networks, CrowdStrike has maintained its premium status because security is mission critical. For a Fortune 500 CEO, the risk of a breach far outweighs the cost of the subscription.
Here at The Good Capital is to give you the same level of institutional research that the guys at Wall Street get, without the $200,000 price tag. We don't take sponsorships from these companies, and we only care about the objective data. If we want to build a portfolio that actually compounds, we need to stop following hype and start following unit economics. If you're finding value in this forensic deep dive, hit that subscribe button and join our community of strategic and informed investors. Also, join as a Good Capital member. You gain early access to new videos, members-only videos, and institutional-grade full analyst reports for respective companies. These are valuable resources to help you spot these red flags before they take away your hard-earned money.
The Valuation Masterclass. I ran the numbers through a 2-stage DFCF. For a high-growth SaaS disruptor like CrowdStrike, the intrinsic value is anchored in its ability to convert annual recurring revenue, ARR, into sustainable free cash flow, FCF. Our model accounts for the current transition from hypergrowth to operational efficiency, fueled by the Falcon Flex platform consolidation strategy. We're using a 9.5% WACC. If you think that's high, remember, risk isn't free. The management is projecting a path to $10 billion in annual recurring revenue, ARR, by 2031. To get there, they need to dominate identity and cloud security as much as they dominate endpoints. Valuation for growth stocks is highly sensitive to the cost of capital, WACC, and long-term growth expectations. The matrix shows the intrinsic value per share under different economic conditions. The market bull scenario.
If interest rates fall and WACC drops to 8.0 with a 4% terminal growth, the intrinsic value jumps to $368.13. The current base scenario, at a 9.5% WACC and 3% terminal growth, the intrinsic value sits at $237.12.
Relative discount. If you look at the forward PS ratio of 22.9x, which is approximately negative 0.3 standard deviations below its 5-year mean 25.5x, CrowdStrike is currently trading at a relative discount to its own historical valuation norms. While a 23x PS is objectively high for the sector, it is statistically normal or low for CrowdStrike's historical range, reflecting market caution following the 2024 outage and general SaaS multiple compression. Statistically, a multiple is not considered screamingly cheap until it reaches negative 1.5 to negative 2.0 standard deviations. Therefore, while 23x PS is a slight discount to CrowdStrike's on history, it is completely normal behavior for the stock and does not yet represent a deep value dislocation. CrowdStrike consistently demonstrates a high Rule of 40 score, often exceeding 40% to 50% by balancing high revenue growth with strong free cash flow. A score above 40 is considered healthy. CRWD's consistent performance above this threshold highlights its efficiency in managing rapid growth with profitability.
The final verdict. While the DFCF suggests a lower entry point based on conservative cash flow discounting, the relative valuation tells a different story. Consolidating intrinsic and relative historical values, we get a fair value of $347. CrowdStrike is an exceptional company, trading at a statistically cheap multiple relative to its own history, but it remains fundamentally expensive relative to its current cash flow generation. The market is pricing in a blue sky scenario, where margins exceed 40% or growth remains above 20% for the next decade. For a disciplined investor, it lacks a deep margin of safety. However, for long-term compounders who believe CrowdStrike will become the dominant AI-native cybersecurity system, it's a top-tier asset. But don't FOMO in the pullback. Monitor the net dollar retention NDR. As long as it stays above 120%, the growth engine is intact. But if you see accounts receivable keep climbing while revenue slows down, the alarm is ringing louder.
At the end of the day, CrowdStrike is a wealth compounding machine, but even the best machines can overheat. Monitor the NDR, the net dollar retention. As long as it stays above 120%, the growth engine is intact. CrowdStrike is racing to $10 billion in annual recurring revenue by 2031. If they get there, today's price will look like a steal. If they don't, it's a long, uncertain route. Most people just read the headlines. We check the facts and navigate through the pitfalls and fluffs. If you want to stay ahead of the market with a level head, hit the bell. We'll see you in the next one.